Bonds are a popular investment vehicle, with municipal bonds and corporate bonds being two of the most common types. While both types of bonds are used by different entities to raise capital, they serve distinct purposes and come with unique characteristics, risks, and benefits. Investors need to understand the fundamental differences between municipal bonds and corporate bonds to make informed investment decisions. In this video, we will explore the top 10 differences between municipal and corporate bonds, helping you understand which investment might be right for you based on your financial goals, risk tolerance, and investment strategy. 1. Issuers. Who issues the bonds? The primary difference between municipal bonds and corporate bonds is the issuer. Municipal bonds are issued by state and local governments, including counties, cities, and other government entities, to raise funds for public projects like schools, highways, or public utilities. On the other hand, corporate bonds are issued by private or public corporations to raise capital for business activities, such as expansion, research and development, or debt refinancing. The distinction in issuers makes municipal bonds subject to government regulations, while corporate bonds are governed by corporate law. 2. Purpose of the bonds. The purpose of municipal bonds is to fund public projects that benefit the community or region, such as infrastructure development, healthcare facilities, or educational institutions. The bonds are designed to support long-term projects that improve public services or build essential infrastructure. In contrast, corporate bonds are issued to help companies fund their operational needs, strategic expansions, or business acquisitions. These projects often have a more direct impact on a company's bottom line, such as enhancing productivity or increasing market share. 3. Tax treatment. Which is more tax-friendly? One of the key advantages of municipal bonds over corporate bonds is the tax treatment. Municipal bonds offer tax-exempt status on the interest income they generate at the federal level, and in many cases, at the state and local levels as well, depending on the investor's state of residence. This tax benefit makes municipal bonds an attractive choice for investors in higher tax brackets who are seeking tax-advantaged income. Corporate bonds, however, do not offer tax exemptions on interest income. The interest earned from corporate bonds is typically subject to federal, state, and local taxes, reducing the overall yield for investors. 4. Risk profile. Default risk and credit ratings. Municipal bonds are generally considered lower risk compared to corporate bonds, primarily because they are backed by the taxing power of local or state governments. Governments can raise taxes or cut public spending to meet bond obligations, which makes municipal bonds less likely to default. However, corporate bonds carry more risk, as companies do not have the same ability to raise taxes. If a corporation encounters financial distress, there is a greater likelihood of default. Credit rating agencies such as Moody's, S&P, and Fitch assign credit ratings to both types of bonds, but corporate bonds tend to have a wider range of credit ratings, with some lower-rated corporate bonds carrying significantly higher default risks. 5. Interest rates. Yields and market conditions. Interest rates, or yields, on municipal bonds tend to be lower than those on corporate bonds. This is because municipal bonds are seen as safer investments due to their lower risk of default and the tax advantages they offer. As a result, investors accept lower yields in exchange for the safety and tax benefits. Corporate bonds, especially those issued by riskier companies, tend to offer higher yields to compensate for the higher default risk. For investors, the yield spread between municipal and corporate bonds can vary depending on economic conditions, interest rate environments, and the creditworthiness of the issuers. 6. Liquidity. Ease of buying and selling. Liquidity refers to how easily an asset can be bought or sold in the market without affecting its price. Corporate bonds tend to have better liquidity compared to municipal bonds. This is because corporate bonds are often issued by large, well-known companies with significant investor interest. The market for corporate bonds is more active, making it easier for investors to trade them. Municipal bonds, on the other hand, can be less liquid, especially for smaller municipalities or bonds that are not widely traded. As a result, municipal bonds may be harder to buy or sell quickly at the desired price, particularly during periods of market volatility. 7. Issuer creditworthiness and impact on bond prices. The creditworthiness of the issuer significantly impacts the bond's price and yield. For municipal bonds, the creditworthiness of the issuing government entity is generally high, with many state and local governments maintaining solid financial standings. However, in some cases, municipalities may face fiscal challenges that could impact their ability to meet bond payments. Corporate bonds, on the other hand, have a broader range of credit ratings, from highly rated investment-grade bonds to lower-rated junk bonds. A corporation's creditworthiness can fluctuate based on its financial health, industry performance, and broader economic conditions, making corporate bonds more sensitive to changes in the company's financial outlook. 8. Bond terms, maturity and structure. Both municipal and corporate bonds come with various maturity periods, but the structure of the bonds can differ. Municipal bonds typically have longer maturity periods, often ranging from 10 to 30 years, reflecting the long-term nature of the public projects they finance. They may also be issued as revenue bonds, backed by specific project revenues, or general obligation bonds, backed by the full taxing power of the government. Corporate bonds, in comparison, can have shorter maturity periods and may be more flexible in their structure. Some corporate bonds are issued with callable options, which allow the company to repay the bonds early, depending on market conditions. These structural differences impact the bond's risk and return profiles. 9. Investor base. Who buys each type of bond? Municipal bonds tend to attract individual investors seeking stable, tax-advantaged income. They are particularly appealing to high-net-worth individuals in higher tax brackets, who benefit from the tax-exempt status of the bonds. Institutional investors, such as insurance companies, mutual funds, and pension funds, may also invest in municipal bonds, particularly those with higher credit ratings. Corporate bonds, however, attract a broader range of investors, including individual investors, institutional investors, and hedge funds. Corporate bonds are popular among investors looking for higher yields and willing to take on more risk in exchange for potentially higher returns. 10. Market and regulatory environment. Municipal bonds and corporate bonds operate in different market and regulatory environments. Municipal bonds are subject to the regulations of municipal bond markets, including state and federal securities laws. The municipal bond market is also influenced by fiscal policies, tax laws, and the financial health of state and local governments. Corporate bonds, on the other hand, are governed by corporate securities laws and are subject to the regulatory oversight of agencies such as the Securities and Exchange Commission, SEC. The corporate bond market is more affected by the economic performance of individual companies, industry trends, and broader market conditions, which can lead to more fluctuations in bond prices. Municipal bonds and corporate bonds are both popular investment options, but they differ in several key areas, from the type of issuer and purpose to tax treatment, risk, and investor base. Municipal bonds are typically safer and offer tax advantages, making them an attractive option for conservative investors and those in higher tax brackets. Corporate bonds, on the other hand, offer higher yields but come with greater risk, especially in the case of lower-rated bonds. Understanding these differences is crucial for investors looking to diversify their portfolios and tailor their bond investments to their specific financial goals. By carefully considering the differences between municipal and corporate bonds, investors can make more informed decisions and better navigate the bond market.